Hey guys, welcome back to the Independent Investor channel. My name is Ryan Chartier. So good to be with you. We talked on the last video about running certain scenarios to really highlight the effect of fees on your investment account. And I posed an extremely scary example, of being the financial institution and taking back my fees all at once. And the only reason why I posed it in that manner is because fees assessed to accounts at 1, 2, 3% over time is really kind of hard to understand the impact. But when we look at it in a different way and we look at the impact of those fees, all at once, it's a real eyebrow raiser. And what I'm going to be doing on this particular video is I'm going to go ahead and offer up the the equation for the statistics that I used yesterday. Just kind of ground truth in the information, guys. What I talked about by taking back that 60%. Okay, that's not my opinion. Okay, that's just math. It's just factual, mathematical, based on a proposed rate of return over time and a proposed contribution amount to those accounts. And what I basically did is I ran a scenario, which I'll be posting on this particular video. And you can play with the numbers in any different way to kind of get yourself to where I need you to be. And that's to realize that there is really no comparison between a zero fee-based account and an account that charges you 1, 2, or 3% maintenance fees going forward. There's really just no comparison. And what I ran last evening, and I'll be posting those figures online, is that if over a 40-year investment time horizon and a max contribution of $458 per month for the course of that 40 years, the comparison between a zero fee account is going to render you $1.4 million over the course of that particular account. Okay, you're going to have $219,000 of contributions over that 40-year time frame. An 8% expected rate of return on average per year renders you $1.4 million. Okay, the exact same situation if you take a 40-year horizon with a 458 monthly contribution and you look at it and you attach a 3% fee. Okay, that's where most people stop. Most people are willing to accept that. They're willing to be backed by an institution, for the comfort and the peace of mind, I guess, that they get out of it. But when you look at over the course of that, running its course and look at what it's going to render you, the exact same situation when you compare them is going to render you $650,000. So just shy of $1 million less in that particular scenario. 219,000 of contributions is only going to render you $650,000. And a lot of people would look at that and say, okay, well, my contributions were $219,000. I've tripled my money. Okay. And the whole point of the Independent Investor channel is to point out the damaging effects of those fees. And, at the end of the day, guys, when we're investing for financial peace and security later on in life, the bottom line that I speak of is money, right? We want to maximize our potential, okay? So when I posed that example in the way that I did, it's not propaganda. It's not meant to, it's not my opinion. These things are just mathematical facts, and there's tools that are available online. I'll post those links again in this video so you can go on there and play with the numbers yourself and get to the same realization that I did. All right, but our focus on the Independent Investor channel is to empower one investor at a time. And, really what that means is to be able to look at, the ability of independent investors to maximize their potential returns over time, and to minimize the effects of fees within those accounts. And, what does it mean to be liberated? I would pose the same example that I posed on my previous video, being able to sit across from your financial institution that you've invested with your whole career upon redemption day. And within a Roth IRA, I've spoke about, the redemption age being 59 and a half when you're eligible for complete withdrawal. And this is the one driving factor that when I was turned on to independent investing, when I thought, I'm going to be 59 and a half someday. Wouldn't it be nice to go in there and be able to pull my contribution and accumulated wealth over time out, not only tax free, but wealth protected? All right, so the same scenario that I posed on my previous video about taking back that 60%, that doesn't occur with independent investing, okay? And the tax shelter that you enjoy over the course of that investment career is also something that you don't have to worry about, okay? So at 59 and a half, you'd be an awful happy camper if you could go in there and say, look, I've accumulated whatever it is, X amount of dollars, or the dollar amount really doesn't matter, it's the program. So if by nature of your contributions you've been able to get up to $400,000 or $500,000 in that account, that money's yours, okay? You don't owe anybody anything. You can go in there and you can ask for a full redemption of those dollars, and those are yours. The IRS can't touch one dime of it, okay? Not only that, but you're rest assured that you're wealth preserving over the course of that, so those dollars aren't being lost under your nose to hidden fees and maintenance fees and things of that nature. Okay, so this is going to be part 2 of investing from a foundational perspective. I'm talking about validating investment, and so when we're talking about liberating independent investors out there, it's like, okay, well, what do I do now with my money? And we spoke on the first video, just touching on some of the themes about some of the main pillars, when you're starting this account. Okay, when we fund the account based on your determined allocation amount, based on your income and your comfort level, and what it is that you want to have in savings to make sure that you can get yourself through a hard time, right, if it comes up. So those investment dollars are being energized into the account, that's being transferred into the account. Now what do we do with it? Okay, and the 3 pillars of investing really is to start with cash. And I thought I would disclose right now, I still feel like, since I've put these videos out over the last month, here we are beginning of 2017, coming into the spring season, my assessment of this market is that it is on a bull run right now of historical precedence. And it's based a lot on the new administration's agenda and what is being proposed to put out there, okay? Whether or not some of these things will come into print and it'll actually become law, all right, I think the market is quite a bit overbought. I think it's overvalued, all right? So I'm just going to go ahead and tell you where I am right now with my allocation, okay? The exact percentage is 53% right now in cash, which is actually a huge amount. For somebody my age right now, I've kind of pared back some of my investments to kind of get to this 53% amount, and that way I can take a little bit better of an entry point if we get a pullback here, okay? And that's kind of the defensive mind that I want to kind of talk about with you guys when you start your investment lives, based on your risk tolerances and some of the other things that I've talked about in my videos. But to start to get this cash account started, and that being one of the pillars, okay? And that way we can take advantage of those opportunities when they exist, all right? So to start, the middle pillar here allows you to enter into a passive investor role to start. And I've talked about all the fundamentals of why we do that. If you have never invested in the market, that gets you practiced on your up and down days. It starts some income generation. It starts the mental conditioning of looking at money in significant of different ways. And that's part of the problem with a lot of folks, is that they just want to look at dollar in and dollar out. I use that example a lot because when the dollar comes in for the income, it automatically goes out in sunken cost instead of paying yourself first and getting used to money taking on these other forms within these accounts. And what I mean by other forms is maybe the first ETF that you buy is a large cap growth ETF that covers any one of the broader markets out there, whether it be the Dow, the NASDAQ, the S&P, or the Russell. And you can start entering into the market. That's going to pay you a 1%, 2%, or 3% dividend back to you. Guys, remember all these wealth accumulation initiatives that we're talking about go right back into your pocket if you're just willing to go ahead and start those accounts. So that's how we start the income generation piece, so you can actually start to get used to and see the results of making free money, because it is possible out there. Okay, that's why we're doing this. We're doing it to invest dollars, to make money back for yourself. All right. It starts you becoming diversified. When you start purchasing these ETFs, it allows you to diversify along a huge amount of stocks within a certain market. Okay, we're going to talk about spiders later, but just the broad index is kind of where I want you guys to look at starting if you don't have a lot of experience with the market. And again, you can take my ideas and you can run with them. If you don't want to do this step, then you can just jump right to an active investor, okay? But a lot of the fundamental approaches that I take on the independent investor are going to be long-standing fundamental approaches as we go forward, okay? I can't 6 months down the line validate information if I'm just telling you, hey, buy these 3 stocks and let's all hope together that they go up. That's not our goal here, okay? We want to be active participants for the long haul, okay? We want to be relevant 6 months, 1 year, 5 years, 10 years down the line, and all this fundamental approach lends its relevance as you start to accumulate wealth in the market, and you start to do it in a careful and calculated manner, okay? And the last thing is it just gives you exposure, all right? Remember that we're going from a non-participant to a participant, all right? And setting up this middle pillar here allows you to enter into the market. It allows you to diversify immediately right away, and it allows you to gain that exposure that you seek, okay? And again, we're in the time that we're in right now, and we're just coming out of an extremely interesting bull run on my assessment over the last 8 or even 9 years, from the downturn of the 2008-2009 kind of financial crisis that was centered a lot around the real estate bubble, okay? And since then, it's been game on, okay? So I don't know how much longer it's going to last, all right? I don't forecast the future. All we do is set up fundamental foundations to allow for an anticipated downturn or a continued bull market going forward, okay? So that's your middle piece here. And you notice here, as you start to become a passive investor, we have that first. You have to become a passive investor to get used to the ups and downs on a diversified plane before you enter into being an active investor. And the active investor, the second tier here we're going to add later is the stock tier, okay? But we're gonna learn these foundational tiers first and get used to how those act, how those react from a day-to-day perspective, how they react to, geopolitical issues, how these ETFs react, what type of range they can work in, and that'll allow you to kind of get used to and kind of assimilate to the market conditions and what they have to offer and those impacts on those accounts. The last pillar we have here is information, all right? And I cannot stress enough that the same financial institution that I talk so adamantly about taking a lot of fees from individual investors has, at the same token, a lot of valuable tools on their particular platforms that can be used free of charge. Again, you're not going to charge yourself for using these. You're going to seek them out, and you're going to find the information for yourself online, and you can find that they're extremely handy in kind of understanding, or giving you access to stock information. It's going to give you your PE ratios. It's going to give you your earnings. It's going to give you, the capital market value of each company. All that stuff's really important. We're going to get in depth on all that stuff, guys. But just to be granted access to that information for free, it'll pay dividends down the road, and you'll end up, just becoming more of an informed participant in the market when we're looking to identify what this informational piece has in your foundation, and it affects your ETF decisions, and it's going to affect your stock decisions, okay? You're going to build watch lists within these accounts, and those watch lists allow you to identify those big companies that everybody should be aware of. And when I say aware of, I'm not talking about just existent. I mean, I'm talking about everything from your day-to-day products to maybe the airline you choose to do, or what credit card is in your wallet, or even what cell phone that you choose to have, or what carrier you choose to go with. All right, it allows your mind to kind of track those things from a broader perspective, and you're not having to commit those things to memory, okay? It allows you to track contributions, okay? If you're doing $100 a month it's going to tell you that you're $1,200 toward your $50 to $5,500 cap. And that tool is free to you, free of charge, guys. And when you get enlightened to the benefits of self-directed IRA investing and independent investing, you're going to start to realize that the information is out there and it is readily available for you to take advantage of, okay? And nobody's going to charge you a dime to take it, okay? The last thing is access to reports, and reports can tell you a lot about how diversified you are within those accounts. It's going to tell you what particular sectors of the market you have and what percentage within those sectors you're exposed to. For example, if you have 20% in energy and the recommended allocation is 10%, that may give you some indication of maybe you should take some profits over there and maybe add, if you don't have a consumer staples, or let's say you've only got 5% in technology, maybe you want to trade and take some profits there and add to that technology sector. And those reports allow you to really get an extremely accurate snapshot of where you are within your portfolio, okay? So guys, as we talked about here, this was just a little bit more in depth on building your foundational approach and the benefits that exist within your self-managed Roth IRA. Hopefully you've enjoyed the video. We take a three-part structure to break it down for folks. Again, it is flexible for any investor because, like I said, no two investment accounts are the same, right? And I would expect that you just take some of these general philosophies about investing and tailor them to your own needs based on your risk tolerance levels and certainly your age and your income levels of where you are. Guys, thank you so much for joining. I hope you enjoyed this particular segment on the Independent Investor channel. Please subscribe to the video. Hit the thumbs up button. If there's somebody out there that you know that needs to be empowered, again, my goal is to empower one investor at a time, and I'd love to have this information in the hands of those folks who need it. Guys, thank you so much, and good luck in your investment future.